It's hard to say. I'm sure China has more gold than they let on. Whether they have that much, it's hard, but it's also possible we have less than we claim. We haven't had an audit in a long time at 89 right now. I mean, we're only $11 away from 100. I mean, we were $11 lower a week ago. I mean, you could have bought silver. It pulled back to like 7 on 71, less than 2 weeks ago. And now it's, 89. But I mean, I don't think silver is going to stop at 100. I think that you could see by the end of the year, $200 silver, and, gold could be getting close to 10,000. In this video, renowned economist and market commentator Peter Schiff analyzes the accelerating momentum in gold and silver and what it could mean going forward. He begins by addressing the uncertainty surrounding official gold reserves, noting that some countries may hold far more gold than they disclose, while others may have significantly less due to the absence of recent audits. This lack of transparency adds to growing concerns about confidence in the global monetary system. Attention then turns to silver's sharp price movement. After pulling back to the low $7 range just weeks ago, silver has surged rapidly toward $90, underscoring how quickly this market can reprice. With that kind of momentum, $100 may only be a psychological level rather than a true ceiling. Based on current trends, silver could continue climbing toward $200 by the end of the year. Gold's outlook is equally striking. As silver leads and monetary pressures intensify, gold could follow with a major breakout in this environment. Gold prices approaching $10,000 are increasingly plausible, reflecting a broader shift away from fiat currencies and toward hard assets as long-term fiscal risks become harder to ignore. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview. Or pass. The gold and silver are getting ahead of that. They're forward looking. The dollar is going to be debased. They're gonna print a lot of money, and that money is going to lose most of its value. And the foreign central banks obviously were able to see this, and they started accumulating a lot of gold a couple years ago, and they're continuing to buy. The public is now waking up. They're buying silver. So, you're going to see more and more money fleeing the fiat dollar-based system into real money. And it's interesting that, the money is not going into Bitcoin. So it looks like that bubble has gotten a bunch of holes in it now. And I think the Bitcoin is digital gold false narrative is going to be deflating. But I think if we get a break in the dollar, if the dollar index, which is right now, 98.99, if we break down to about 70 by the end of the year, we could easily see gold. I don't know if gold will hit 10,000 this year. It may not. It may take till next year, but I mean, it's going there. But silver, silver could hit 200 before gold hits 10,000. I think the dollar should be weaker in 2026 than it was in 2025 because we only had weakness in the first half of the year. The dollar kind of stabilized and bounced back a bit. And I also think we'll see more weakness in the bond market unless, of course, the Fed comes in with an aggressive QE program, steps up what they got now, and that might slow the rate of rise of bond yields, but it will accelerate the move up in gold and silver and the move down in the dollar. when they used that analogy of the dollar being the cleanest shirt in a hamper. It was to say that there was no alternative, that, look, the world is stuck with the dollar because everything else is worse, right? And I always pointed out, no, gold is an alternative and gold is not in the hamper at all. And so people that were thinking that the dollar's reign as the reserve currency was safe because no other currencies were good enough to take its place. My point was, we don't need another currency. We need real money. We need gold to replace the dollar. And that is exactly what is happening. Look at the bond market. Look at the dollar. But obviously you can see it in the precious metals market, but only the precious metals market. Well, prices are going up too. I mean, copper hit a record high. So, it's not just precious metals, but it's all the precious metals as platinum, palladium, everything is moving up. So I think the metals are more sensitive to increases in the perception of the inflation risks and a loss of confidence in the dollar than other markets might be. But those other markets will ultimately react to what the precious metals market has already sniffed out. I mean, obviously, we're not in the infancy here. We've had a big move up. I think we've kind of just recently broken out. I think last year was kind of really the breakout for the mining stocks, and silver in 2024 was the breakout for gold. So this new leg of this bull market, which has been ongoing, I mean, gold's been in a bull market since 1999, and it was under 300, but it consolidated from 2011 to 2024. So that was a long period to consolidate and form a base. So gold broke out in 2024, the miners broke out, and the silver broke out in 2025. So this is really the first year, 2026, where we have already broke out. We have the breakout in the precious metals, not just gold, but all the precious metals. Because platinum didn't do that until this year also, right? It was a gold story in 2024, only gold, and it broadened out to the rest of the precious metals in 2025, and the mining stocks finally started to move. So I think this is the first year of what's going to be a big precious metals bull market. It's not the ground floor, but it's close enough compared to where we're going to end up. In this interview, the focus is on why gold and silver are moving ahead of traditional markets and what that signals for the global monetary system. Precious metals are described as forward-looking indicators reflecting expectations of currency debasement and large-scale money printing. As confidence in fiat currencies weakens, foreign central banks have been steadily accumulating gold, a trend that began years ago and continues today. More recently, the public has also started shifting into silver, accelerating the move away from the dollar-based system and into real money. The discussion contrasts this flow into physical metals with the fading narrative of digital assets as safe havens. Instead of capital moving into cryptocurrencies, increasing demand is being seen in tangible commodities. A significant breakdown in the dollar index could further intensify this trend, pushing gold toward much higher levels over time, while silver could advance even faster. The interview also explores broader market signals, including rising bond yields, ongoing stress in the bond market, and record highs across industrial and precious metals such as copper, platinum, and palladium. These moves suggest that metals are more sensitive to inflation risk and confidence loss than other asset classes. With multiple breakouts already confirmed across gold, silver, miners, and other metals, this phase marks the early stretch, a powerful, broad-based precious metals bull market. Let's get into the interview. I mean, their plan is probably going to be to go down the curve because they need to bring down the long-term rates if they want to bring down mortgage rates, for example. But most of what the Fed is doing now, right, is in the short end. They're buying treasuries. They're trying to keep the short end down, and that's where the government is issuing the vast majority of its new debt. So, we've got at a $3 trillion national, budget deficit now, and that's being financed with short-term money. They're not going and selling 30-year bonds or even 10-year bonds. They're out there in the short-term market, trying to find, these obligations, which is obviously going to blow up at some point, because if the Fed is forced to jack up short-term interest rates, like Volcker did, where they went to, imagine if they just went to 10%, half of where they went. Under Volcker, even though they should go even higher than they did back then. We're in much worse fiscal shape now, and we have a much bigger inflation problem. So if rates went to 20% in 1980, God knows how high they'd have to go now. But the problem is we could afford 20% in 1980. We can't afford half of that now. I mean, not even close to half of that. Yeah, that's why our gold fund is a great buy right now. EPGIX is the no-load symbol. We have a lot of juniors. We built these positions up over the years, and it'd be hard to accumulate those positions now in the kind of size that we got. So yeah, I think we have a lot of potential. I think a lot of those companies are going to get bought out. I think there's going to be a big consolidation in the industry, and the bigger companies are going to look to expand their reserves. And the cheapest way to do that, the quickest way to do that, is to go to these smaller companies and buy them up, because a lot of the smaller companies don't even have the cash to develop their resources. But the big companies are going to be swimming in cash because they have substantial existing mining operations. As this discussion comes to a close, it highlights a growing imbalance at the heart of the financial system. Massive deficits are increasingly financed at the short end of the yield curve, creating a structure that depends on low interest rates to remain intact. This approach may work temporarily, but history shows it becomes fragile as inflation pressures build and refinancing risks compound. The longer this continues, the narrower the range of viable policy options becomes. At the same time, capital allocation across markets is beginning to reflect these stresses. Large institutions and well-capitalized players are positioning for a future where monetary conditions look very different from today. In the mining sector, that shift is already visible through consolidation, strategic acquisitions, and increased focus on reserve growth. Smaller companies with valuable resources but limited funding are becoming natural targets as larger firms look to expand efficiently. Taken together, these signals suggest the market is entering a new phase, one driven less by short-term narratives and more by long-term fundamentals. Understanding how interest rates, debt, and real assets interact is becoming increasingly important for anyone watching the broader macro picture. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.